Hello, in this video, I would like to talk about sensitivity analysis for Apple. And to get more accurate results, since my model is not that big, I will run the simulation instead of 1,000 times. This time I will add another zero here, 10,000 times. And also, I would like to make a few more changes. I would like to define my decisions, although these are not necessarily decisions in terms of intrinsic thing that I can change, or endogenous, I would say. These are more exogenous factors, but I'm not quite sure about them. So beta coefficient is one thing that is calculated based on last 5 years. But some scholars may argue that you need to use industry average, or in the future, company may get more risky or less risky. So I would like to see what are the different possible values of this beta coefficient will change my forecast, which is the intrinsic value of equity per share. So I will define this as a decision. And here I would like to try different values between 1, which is the market risk. I'll put here 1. And then I will choose something that is higher than current one, which is 1.23. I will just use 1.4. How would that change my overall intrinsic value? So this is more like what if analysis or simulation or sensitivity analysis. And I will assume that this is going to change step values of 0.1, so I can see the different values. Click OK. So you see this cell became yellow. Another thing that I think highly uncertain in this model is expected market return. Based on historical data, we assume that to be 6.8%. But what if it changes between, let's say, reasonable range of 4% to or 5% to 5% to 9%? And then again, I would choose here discrete, and I will increase it by the percentages of 1% at a time. Click OK. Another thing that I think is highly uncertain in this model is that the reinvestment rate. There was a formula here, again, revenue divided by total debts plus total equity minus cash. If that's the formula there, please replace that by 2.7 because we calculate that. Because if there's a formula, crystal ball won't allow us to define as a decision. So I would just define it as a decision as well. Let's say, what if the investment rate is between 2.4 to 3. And again, let's choose discrete, and let's increase our steps by 0.1 at a time to see what would that give us. Another thing that is hard to predict, I would say, is the tax rate. So we assume that it's going to be 16% based on historical numbers. What if we change this value between 21%, which is the current highest tax rate for corporate earnings, and to, let's say, something reasonable that is maybe 10%. And let's go increments of, again, 1% at a time. Click OK. So I define 4 decisions. All right, so now I would like to run this model. For 10,000 simulations. Takes a little bit longer, but again, the model is not so big, so I can run 10,000 times to get more accurate results. Again, you can see the results that current price, we look at 445% dollars. A probability of the intrinsic value per share to be lower than the current price is almost 80%. Okay, so another thing I would like to show you here is sensitivity analysis. You can see here that the most important factors at the top and least important factors at the bottom. And you can see that the most important things are looks at productivity, percent change numbers. And at the beginning of the this 2, 3, 4 represents basically next year to 2021, 2022, and 2023. Those productivity changes are the biggest contributors to our intrinsic value calculation. So we gotta make sure that we understand those estimates pretty good. Otherwise, the changes on those inputs can make big changes in our outputs. And you can see their corresponding correlation values to the intrinsic value. And then you can see the other factors here. One thing that's important to see here that the more later the data or input is, which is 10, 9, 11, 8, so on, the least important it is. So it is important to better understand as an investor the assumptions about near future, because near future assumptions can make bigger difference in comparison to further in our timeline. Or in other words, our forecast, which is intrinsic value, is more sensitive to the changes in the near future. Another thing I can show you here is that the sensitivity. I can show you here scatter chart. This may take some time. It's loading. You can see here I show scatter charts basically for matrix view and n by n. Again, it's quite a bit of matrix because I have so many assumptions. And you can see, I'm not going to go into each chart here one by one, but you can see here, my computer is a little bit slow. You can see here the correlations between the output values and the input values, as well as input values to input values. Again, my computer is right now a little bit slow, but what I can show you here, for example, that revenue growth, which is seventh revenue growth, 2 is 2021, so 5-6 years from now, 2026, is, you see the correlation with the forecast, which is the intrinsic value. So the higher the growth rate for revenue, the higher the intrinsic value, obviously. And you can see the same kind of relationship here. The higher the revenue growth for year 7, which is 8-7, the higher intrinsic value. Again, you can see same situation for even revenue growth 6. So what you see here is that when the revenue growth is higher, you see higher intrinsic value as we expected. Another thing I would like to show you here is that tornado charts and spider charts. Let me just put these graphs down below. And now what I would like to show you here is more tools. You can click here, tornado analysis. I will choose my dependent variable, which is equity per share, intrinsic value. Next. And then you can see our decisions here. You can click next. And then you can click run. Now you can see that, for example, between these 3 inputs, beta coefficient is the most important factor. And when the beta coefficient is greater, our intrinsic value goes down. When our beta coefficient is lower, our intrinsic value goes up. So if we think that the beta coefficient has higher chance to be lower, then we may want to pay higher dollars for our stocks. But if we think that the beta coefficient is going to get higher, or there's a higher chance of we are underestimating beta coefficient, we may need to pay less money for Apple stock per share. As you see, reinvestment rate doesn't make much difference, so we don't have to worry about much. But expected market return, also you can see that negative correlation here, that if we expect the market return next decade to be lower, like around 5%, we may want to pay more money per share. However, if you think that the expected market return for the future is going to be higher, then we need to pay less money per share to be able to benefit. So you can see here the explain variation. For example, beta coefficient can explain 55, almost 56% of the variation in intrinsic value. And these are cumulative. If we consider beta and expected market return together, we can explain over almost 100% of the variation in intrinsic value. Another thing I would like to show you here is the spider chart. Basically, the reinvestment rate, again, doesn't make much difference, but the higher the reinvestment rate, slightly better, higher results for intrinsic value. But again, you can see that beta coefficient and the expected market return can make significant change in our intrinsic value. So the higher those values are, the lower the intrinsic value is. That's it for this video. Until next video, enjoy valuations.